The Hedgeless Horseman here. It's April the 15th, 2025. I thought I would do a video about just going back to the basics of cyclicality. What is a cyclical sector? How do you take advantage of a cyclical sector? What is the only real, well, the the one thing you really should not do in a cyclical sector? I mean, it's very basic stuff. It's common sense stuff. But it's like, I mean, few people actually get it. It's like I see some people who've been following me for months, if not years, on Twitter. Uh, they they kind of forget the basics almost every other day, in a sense. I mean, it's like I'm actually, kind of exhausted from providing quotation copium almost every day on Twitter, because like I think that we might be in for a multi-year bull. Who knows? Maybe a 10-year bull or something, because that's what happened last time. The tech bubble basically burst, and yeah, miners had 11 years from 2000 2011, and in between there's going to be majority of the time the juniors and miners are going to be consolidating. So we're talking like years worth of consolidation combined. Then there's going to be corrections, and then there's going to be updates, and the updates are typically never going to be big enough, let's say, for people not to complain. So I mean, I hopefully will not be spending as much time on Twitter, because I feel like it's taking up again so much of my time. Partly, of course, it's therapeutical for myself as well, just hammering home the basic things of not selling cheap. But it's like this should really, I mean, once you really get it, you're not going to be as frustrated anymore, because it's going to feel like you're winning every day in a sense, because you know what you're doing is correct, it makes sense, and it's just a matter of time until you get whatever paid off on your average holding, let's say. So then kind of all the stress will go away, because you're gonna be thinking that you're sitting on a winning scratch lottery ticket, and you're just waiting for the price to come to you. Basically, that's how I think one should see it, especially at historically cheap levels, generationally cheap levels. I mean, if there was any point in time, at least in the last 10 years, where I would think that, the portfolio is probably going to be quite a bit higher in the future than it is today, that would be basically today. Let's just first look at the markets. I haven't followed metals that much. Appears gold is up, silver's up a bit, crypto going down. Yeah, stocks, I don't know, undecided, let's say. I mean, again, this is absolute noise. Gold might as well be down tomorrow, and if it's down tomorrow, I bet it's going to be green the next day, and so forth and so on. Has absolutely really no impact. I mean, when you think about it, some juniors out there, let's say they have an advanced product, NPV, let's say gold goes up or down 1%, that might, I don't know, add or subtract, I have no idea, 15 million or something to the MPV, or 20 million, whatever it might be, depends on the project. Because that's one thing also. It's like, I think recently it was the first day that gold has ever gone up $100 in one day. So the percentage terms is not even giving gold justice, really. Because the thing is, I mean, this is how absurd it's getting. So let's say gold went up, as I think it did, $100 in one day. That's another $100 per ounce in revenue. Sure, it could go down the next day, but we don't know that. That's $100 extra of revenue, and therefore, I mean, given the margins today, that's $100 in net margin per ounce produced. $100, and there's stuff selling out there in the junior space. Good projects, they're selling for maybe $50 to $100 per ounce. That's how crazy it is. So everything here is just a rounding error, basically. Because it's not like, oh, if gold went up $100, now these ounces have $100 margin. No, they might have gone from like $1,800 margin to $1,900 margin, and the ounces in the ground are selling for 15 to 100. I mean, nobody's ever seen anything like it. So if you're selling, you gotta, if you're a value investor or anywhere close to a value investor, you should be selling because in that case you think $50 to $100 per ounce is expensive, regardless of the fact that, or in light of the fact that the margins on some of these projects might be $1,500 to $2,000. I mean, obviously, that's if you think that's expensive. I mean, there's no reason behind it, given that this sector has never been this cheap. We never had as high margins as today, and the gold ounces in the ground has never sold for this cheap relative to what the margins are for gold ounces being produced. So it's never ever, I don't think, not in the last 3-4 decades, probably ever been cheaper to buy an ounce in the ground relative to what that ounce in the ground is worth. So if you're selling, you're certainly not selling because of undervaluation or I should say overvaluation, because it's literally never been cheaper. So one thing, again, it's like I look at TA and charts more to amuse myself than anything else. I mean, I've shown this chart. I remember, no, this is not that one. Not this one either. Here. So this is a Nasdaq divided by HUE, which is or HUE, which is a mining index. I remember I put this chart up. Well, I put it up a bunch of times, but I remember when I put it out, and it's like the ratio literally hit the same level that it hit when Nasdaq peaked against gold miners back in October of 2000, and then you can see what happened afterwards. That was literally the bottom. Maybe, I mean, this is a monthly chart, so it looks like it was as accurate to, one tick, which is 1 month. After that top, this is what the HU or the HUE index did for the next 11 years. Again, and note what I said before, this is a long time of consolidation. One could say this is consolidation, so that's almost a year consolidation. This is sideways to down consolidation, or let's take it here from here. That's almost 2 years of consolidation before it ripped. So my point is that, again, get comfortable being bored. Get comfortable doing absolutely nothing, let's say. Because even in the most epic bull market most people have ever experienced who are still alive, which is kind of the 2011, there were still years when the mining indices at least, traded sideways or traded down within a roaring bull market. And people are bitching today every time gold is down or every time the juniors are not up. And this is at least what I'm not saying that every junior has gone up like this, because I don't think so. But still, my point is that it's never enough. It's never enough. Because most people have this idea that they should be, especially if they're down, that they should be making 100% per 6 months or per 3 months or something. I mean, people have the worst historic returns are the ones chasing the highest returns. Despite the fact that it's their incessant chasing of these unrealistically good returns that made them get very low returns. Why? Because they bought into this sector. Most people enter a sector, so I'm not judging that. But people buy into the sector when those miracle returns have happened already. A lot of people got in here. Why? Because this is what has happened before. And you can look at historically here again. It's like even in the bulls, okay, this was a run, obviously. This was a run, really good run. Then consolidation for over twice that time period. then it ran again, then consolidation for 3-4 times the time length of the previous run-up, and then it ran again and consolidated. So that's what you kind of should be expecting. Most of the time, even in a bull market, this sector won't do anything, and that is what you should be expecting. Looking at your portfolio every day, it's like, oh, am I rich yet? Am I rich yet? That's a warning sign, a real warning sign. I mean, I've said this before, my goal is to kind of compound at 50% per year. And that obviously gets harder and harder the bigger the portfolio is. And at some point that's going to be really hard. But if that becomes really hard, I assume it's because my portfolio will be very, very big. But that's 50% per year. Let's say if you average 100% every 2 years, a double every 2 years. Again, most people are chasing the double in the next month, but every 2 years, that's around, I think, 42% per year, which is absolutely superb returns. And 42% per year is a compounded monthly rate of like, I don't remember if it's like 1.8% or 2% something. You can barely notice it. I mean, literally every junior moves that much up or down on any given day. And a superb run rate would be to average 2% per month. That's like, people need to get their, expectations corrected. And that's the thing. It's like, when people have no idea what to expect, let's say, they don't know where they are, if that makes sense. So if you just get this idea that even in a bull market, even if we're in for a 10-year bull market, most days the juniors won't move up. And if you have a really good average annual return, let's say 42%, that's still just going to show up on as, let's say, 1.8 to 2% per month. Which is kind of barely noticeable. I mean, again, most people are bitching right now because they want to see the, miracle returns, like, 300-400% in 6 months when everything just goes straight up and it makes them feel good. But that's, again, how they got into trouble the first time. So, I mean, point is that if you're looking for constant action or whatever, you're not even going to recognize a bull market. Because the rips, the rallies, the revaluations, they tend to happen relatively seldom, even in a bull market. And you never really know when it happens, or when it's gonna happen. And you can look at, it's like everybody's says like, oh, Great Bear, for example, that was a great chart. That was or obviously it was a great short, but let's see here. I'm gonna see if I can find it. Yeah, okay. So this is Great Bear, obviously. 1 second. This might be better. So this is Great Bear. Yes, if you look back at it, zoom out, it's like, whoa, what a run from whatever the discovery hole went up to like $1 or something. I mean, it became like a 28 bagger, basically. And people look at it, it's like, oh, I want to be a part of this. It's like, oh, I'm going to find the next one. And that's mostly from people who, again, like Rick Rule says, can't hold over a long weekend. People think it's easy if this was easy to identify and all that and make a shit ton of money, a lot of people would be doing that. I missed the run in Great Bear, for example. I owned it before the discovery, sold it at like 17 cents or 19 cents after holding it a week or something. I thought about buying it. I had a bid in, I don't remember what, at like 260 or something around here. It didn't hit, so I never bought it, and I missed the whole run. But don't kid yourself thinking it was easy to hold Great Bear to a 20 plus bagger. You see the same phenomena here. discovery, consolidation for a couple of months, went up, then basically went nowhere for several months again. Again, from a hodler's perspective, then it ripped, went sideways for many months, then dipped, and almost it's back to level seen 1.5 years ago. And then it went on this, like a lot of stuff did after the COVID flash crash. Went on an absolute tear. And then it literally consolidated for sideways to down for, I don't know how long this is. But don't kid yourself that, if you were just in Great Bear, it's like everybody would have, including myself, would have such an easy time sitting through this kind of correction or consolidation. And then again the ripped happens. So even in the most absurdly, or one of the best success cases, and you can look at Snowline Gold, it's kind of the same thing. Even in the best success cases, the actual net gains were like here. That's not, this is just over, this is a daily chart, so let's say a week consolidation, then like, I don't know, 3 weeks. And then it was not until here where it's actually put on a net gain. This is maybe a week's worth of rally, consolidate, turn down, and then it's like, I don't know how long this is, let's say a month. And then it topped again. So literally like 80 to 90% Great Bear was either consolidating or spent in a correction. But the actual net gains were just 10% of the time or something. So if you hold this, if you only shear, let's say, when there's a net gain, because like, even if you bought it here, if you saw this, you wouldn't be shearing here even though you're ahead, right? So there's going to be people bitching and complaining at every single correction here. Because, it kind of makes sense. If you bought it here and held it up to here, and then you're in for this, it's like, opportunity cost, why am I in this stock? I'm losing money on paper from the peak. But it's like, if you go back in time, then you're going to see, oh my God, if I despite the fact that it felt like torture for like 80% of the time, I actually made 4 or 5 bagger over 2 years, which is absolutely remarkable returns. That is one thing. It's like people think that a 10 bagger is some easy journey. It's just going straight up. It is not going straight up. I don't know what the annual compound rate here, but let's say it's 60%. 60% per year, and you get to like, maybe it's actually more. I haven't, I did a calculation way back. So that's the thing. Get this into your head, and that should guide your expectations. Because if you are prepared psychologically, it's like Chris Martensen, I think, says about a crisis, whatever. It's like the most important thing is to be psychologically prepared for it. It won't come as a shock. So if you're prepared, if I'm telling you now that even in a bull market, you're probably going to feel like we're in a bear market for most of the time. And the only times, even a success case or even a bull market is going to feel like an actual bull market, is just going to be over period here, period there, this period, that period. And then you're going to, here you gave back all the gains for many, many years. And then most of the time actually here, it felt like a roaring bull market. And of course, this was such a climb that sentiment, because everybody loves momentum. So the clearer the uptrend, the more people get excited. So here, I wasn't around back then, but I heard that, the gold sentiment, I thought the gold sentiment and the mining sentiment was hot here. Apparently it was nothing compared to how it was 2011. But it makes sense. This it wasn't as long of a clean uptrend, even though these returns here were absolutely absurd. But here you had kind of these, the gift that keeps giving. And then of course, the higher in space, the more gain, the more pain, and vice versa. So I think we're gonna have a heck of a. I mean, one could draw a trend line here. So it's like I think I've said this before. I think the bull market started in 2024. But don't kid yourself thinking that even if we're in a bull market, it's gonna feel like a bull market. 80%, most days it's not gonna feel like we're even in a bull market. And you're gonna see these juniors, John. They go up to some level, and you're like, yeah, now it's on, and you're gonna see people posting about some stock is up 20-30% or something, and you're gonna be expecting that, oh man, okay, it's a rush, you made 30% in that position in one day, and then that might be the top, that might be where did I put that? That might be whatever, one of these peers, and then you kind of give it all back, and then you start thinking like, oh man, this sucks, really. Oh, and then it comes back, but it's just to the same level, so you're not that excited. But then something, it starts to happen again, and then you go into this, and then you have a euphoria, and then it goes down again, and you're like, oh, blah blah blah. But if you just suffer through that in an intact story, for example, fast forward 2 years, even though 80% of the time it might have felt shitty, it's like when you zoom out at the end of the day, if the company just keeps on adding value, it's going to be reflected one day. And again, it's like I've said this before, here the stock price was like $13, less than that. Not too long after, Great Bear sold for $28. So that's minimum what Kinross thought Great Bear was worth. Because they obviously aren't feeling like they're overpaying for it. If that's right or wrong, it's up to each and every one. But the market was over 100% wrong on Great Bear, which was not an unknown story, was not a low-profile sleeper story, but the market was still 100% wrong according to Kinross just a few months before they bought it. Which says something again. It's like, how rational is the market? But you see, I mean, look at how many traders were in here. And you see these patterns in a bunch of juniors. Nothing to do with fundamentals. Fundamentals might have been going like that, but as soon as, I mean, it's easier to get people to sell, because I would assume, again, this is what Kinross is saying the value is at least. So if we just draw a straight line here, maybe the gap, price to value gap here was the largest ever in Great Bear, maybe. But people are still selling, so they're selling when it's the cheapest. That doesn't make sense, but that's what people do after they see this kind of trend line, give up hope, and thinking that the market is right, yada yada. I hope that made some sense. It's like, I mean, I'm looking at some, my favorite juniors right now, it might be in a correction. It's like, I don't sweat it, because I am 100% convinced, until I, convince myself otherwise, that the market is absolutely 100% wrong, and it's going to show one day, and then I'm going to make money. If it gets me to sell some of these dirt cheap, extremely cheap, generationally cheap juniors because it's not going up yet, then the market won, and I deserve not to make any money, because I literally sold an absolute no-brainer, because I haven't been paid yet. Well, that's what people did at every single one of these corrections and consolidations. That's what people did every consolidation here, and then it kept going. People sold the lows here before the best quarterly rally ever. People sold here because it was never going to go up, yada yada. So we all get what we deserve in the end. Then we have. So this is the Hue index. I mean, again, I don't trade based on this. I don't own the Huey, and this sector is kind of famous for doing, quote, false breakouts or false breakdowns. I mean, take here, you can draw a line, and it's like, oh, the sector went up here, it broke through this. I mean, this is some kind of, line here. I mean, here, same level, same level, same level, same level. And yes, it went higher, but then it topped for the next, 3 years or something. So I don't it's not like I'm rushing in because Hue is above this level, and anything could happen. But this can also be, for real, in a sense. This might not be a false break out. and this is the S&P to Huey chart. Uh, it's like a lot of people are talking about sector rotation. Again, that's just, I mean, that's controlling money flow. Again, everyone and their mother, especially today, wants to be in this sector that has done well in the recent past. That's just how it is. I don't make the rules. My view is that I want to be in long before the hot money, the dumb money, the momentum money gets in. When they get in, they might push it a lot higher than it should be eventually. But if I think it's just a matter of time, it's like I don't need to, I mean, if I'm buying, this breakout, it's like, well, I could have been buying down here or down here before that. So I'm thinking I'm leaving money on the table just waiting for this. And whatever, this could be theoretically also a false breakdown, whatever, that the sector rotation is not starting. Well, then I bought high maybe. Like, whatever, it broke here, so I'm buying this or okay, this wasn't maybe best example, but like this sector is not that forgiving for people who buy tops. It's very forgiving for people who buy anywhere near, theoretical bottoms. Anyway, so it's like, yeah, we saw the Nasdaq breaking down against the Huey. This is S&P. I mean, this looks like a false break to the upside, and typically, I guess that's what tends to happen at extremes, let's say. I mean, this was such a obvious resistance line, broke up to get everybody on the wrong side, let's say, and that might have indeed been the top of this chart. I mean, it doesn't look as disgusting as the Nasdaq Huey chart, but at the same time, I mean, it's been an AI Bitcoin crypto bubble, so I guess tech has been more bloated in terms of valuations than the run-of-the-mill companies. But this is at least signs that like, hey, there might be some rotation going on or starting or whatever. And I mean, just look at Integra. It's like that has been dirt cheap for, well, ever since the takeover, really, or the merger. It's like somebody said, and I don't remember that George said this, but George had said they were expecting like 20 million free cash flow or something per year from Florida Canyon, not 90 million, which it's kind of looks like the run rate is now. So it's kind of surprised to the upside by multiples, and the stock has not really priced that in at all. It didn't even price in Florida Canyon's current cash flow, let alone Delamar and Nevada North. But all of a sudden, in the recent, few days, Integra has just started going up. So what does that mean? That it went up when Integra was cheap? No. It was cheap before that. It's been cheap for months. Just never know when the market is gonna get its head out of its ass and actually, start to price in the obvious, let's say. Yeah, I just used RSI as well. I mean, again, don't trade based on this, but I just find it interesting. It's like, okay, here one could make some kind of a trend line, and it's like, okay, when this broke up, when S&P divided by Huey broke up in terms of RSI, that's around here. So that's actually around the top, and now it's kind of broken down. The lowest level since, well, at least 2006, but maybe 2023. And that's like, the start of, every single one of these breakdowns or RSIs hit this low was kind of at least a bottom in Huey, let's say. So I mean, this might be nothing, and again, I can't predict. I'm not, my portfolio is not resting whether this is a breakdown of S&P against Huey. I'm just saying that it's interesting that one could draw, I guess, a line like that. And RSI trend lines I actually look at, because historically it's the only simple tool I've seen that kinda, I think, is somewhat good at capturing when there's, acceleration happening or is about to happen, or if there's a serious break or something, a serious move. So if this has broken down, that might be a big deal. That's like literally this was the top, 2024. That was the bottom, and we're about to hit the acceleration phase thanks to sector rotation. And like I post here, ratios breaking down versus miners, gold on the way of breaking a decades-long RSI line on the monthly. Imagine a sector rotation while gold keeps going higher and the starting place is generational undervaluation. So that's what I keep saying. It's like you see people who are so downtrodden that they're like, oh, I can't wait to get out that break even. They're saying that when it's like this sector has never been cheaper, never been more underinvested. Gold margins have never been higher. The juniors have never sold as cheap as this relative to the value of a gold ounce in the ground. And people are like, yeah, if I'm back to even, let's say 100% return, then I'm getting out. It's like, what the heck? I mean, if we're in a historic undervaluation, that kind of suggests that the mean reversion will be historic as well. And typically it doesn't stop at the mean, it actually overshoots. So if you're thinking that 100% will be anything, I think you're about to sell very, very early. And then I had some other ones. Let's see. Yes, okay. Again, just also to show the duality of this sector in a sense. So this is First Majestic. I just took this has been around for a long time. I think it's been a producer of some sort through most of the time. I don't own First Majestic. I owned it briefly down here. I remember when I was buying it going down here, and I think I sold it here or something because I thought it was overvalued relative to some other juniors, because I kept a spreadsheet and just looked at price to revenue and all that. So I sold here thinking that First Majestic on a relative basis was getting kind of pricey. This is what happened afterwards. I can predict how dumb the market is going to go on the low side like we're seeing now. Never in my life would have I predicted that gold would be $3,250. The average gold margin of ounces produced is $1,700, which is higher than the gold price was a few years back, and I can buy ounces in the ground, high quality ounces for $50 to $100. Never in my life. If somebody said that to me, I would never ever have believed them. I would probably bet a lot of money that would be impossible to happen. But it happened. That's why I've never been more bullish. I was bullish all the way down here. It just got an increasingly bullish the cheaper it gets. And I had no idea First Majestic was just gonna keep rocketing basically to whatever level. I should kind of have been prepared for it because this isn't that long ago, and it kind of did the same. And here this wasn't as clean, I guess, but this was a rocket, that's a rocket. So my point is, at these tops, this was a major top, as we see. I mean, euphoric top. This was a very high sentiment top. Gold miners priced in, or silver miners especially, priced in a higher silver price than spot. Imagine if gold juniors or gold producers were going to price in a much higher gold price than current spot. I mean, like I showed in the last video, apparently Newmont isn't even pricing in the current spot price. So even Newmont might have 100% upside or more if gold keeps going. But so compare the delta going from historically undervalued levels to a classic top when they will be overpriced. I mean, the delta, I don't know what it is. Anyway, so here at every single one of these sentiment tops, I've done rectangles here where you can see that every single historic buy within this rectangle was showing a profit. You would just hold the stock after you bought it. The only buys that would show a negative return would be here, here, and briefly here. Every single unfortunately I don't have a time scale here, but I think this goes back to 2005 maybe. So literally almost every 99% of all your buys in First Majestic would have been in profit here. At this top, most of your buys would have been in profit or extreme profit. Any historic buy. At this top, every single buy over the last X amount of years would show extreme profit or at least very good profit. So in a sense, if you're in this sector to a sentiment high, a major or even medium-term sentiment high, every single buy basically, assuming the junior you own hasn't been, it's still around, let's say, it's somewhat the same company and it's not a failed case. You're going to look like a genius on every single buy, and basically it makes you think that it's impossible to lose in this sector. The flip side of that is, at every bottom, the opposite is going to be true. Here, every single buy within this rectangle would show a loss. Down here, every single buy within this rectangle, basically, 100% since 2004. Here, almost every buy would show a loss over the last, 10, 15 years. And here, again, pretty much every buy would be a loss. Same stock, same sector. At sentiment highs, you cannot lose. At sentiment lows, you cannot win. Same sector, same stock, same commodity. Totally different pictures. That is the definition of a cyclical sector. Every single top is basically a black swan event. Every single bottom is basically a black swan event. At the tops, you can't go wrong. You made money on every single buy almost you ever did. At bottoms, you would be losing money on every single buy kind you ever did. And the difference can sometimes be just 8 months apart. Or in this case, I guess 2 years. So which means at certain times this sector is almost impossible to both win and lose in. Some will say that one needs great timing, because somebody commented like, oh, well, you need great timing. But does one really? If you think one needs to buy at the bottom to make money, I guess your CAGR goal is to average 1,000% per year. Think about this when people say, oh, that means, if you look at this and think that, oh, then I need great timing. It's like, what are you smoking? Do you literally think, I've said this before, a lot of times, you can go back in my videos, people are delude themselves in thinking that the reason they are losing money in this sector is not because they bought here and refused to buy here, or even, God forbid, sell down here. And I don't own First Majestic, I'm just using this as an example. I don't know it well enough, and historically I never really liked their fundamentals, even though I bought it for a brief period of time, or owned it for a brief period of time. And it's like, I literally think I would, if I bought First Majestic today, I'm gonna end up making money, okay? Without even knowing anything about the fundamentals. Anyway, point is, think about how irrational that is to look at a chart like this. You can see the share price numbers here and thinking that, oh yeah, that I think that's a kind of an excuse copium that people like, oh, confirmation bias. They think that, right, the reason I'm not making money is because I haven't literally timed the low, not lows, just pretty much the low. And that's so hard, and they tell me that's so hard, and that's why it's like impossible to make any money. It's like, it's time for a reality check. How good of a timing do you actually need? This is First Majestic, a weekly chart. I just drew a trend line through here. Let's assume this is like a trading sardine that doesn't dilute too much, whatever. It's like Bear Creek Mining, for example. They've changed a lot. They become I think a low margin producer. They should be making some money today, but that's changed a lot. They don't only have that Korani project anymore. So unfortunately, that's not quite as useful, I don't think, as trading sardine proxy. Or maybe it is. It's way down in the pits of hell, basically. So maybe it is actually telling, because it's sure enough, if we look at the discrepancy between ounces in the ground and value of ounces in the ground, it's never been higher. So in a sense, maybe Bear Creek Mining is actually the best proxy because it's literally like down here or something. So yeah. Anyway, my point is that if you think you need to, or people think the reason they don't make any money is because they didn't buy here. No, I'm telling you, it's like the reason people don't make money is because they buy when the sector has done well already, really well. It's like Black Swan type events, like Six Sigma events, kind of well. That's when they buy in, because then they think the best is yet ahead. I mean, literally, people buy here because they think it's going to go there, and people sell down here because they think it's going to go down there. Then it rolls over. They might, let's say, they average down for a bit here because that's typically what happens. So they start to average down maybe here or something. Then it goes lower. Then they quit buying, let's say. And then most of the time I think they give up and sell somewhere around here or refuse to buy anymore until they're, quote, back to break even so they can leave this sector. Never crossed their mind that if they just look at any cyclical sector, you could pretty much tell that as soon as a cyclical sector has crashed, you should just be buying hand over fist until you reach next sentiment high. And again, if we're while on the discussion of timing, I mean, how much timing would you need? So every single buy obviously here would show a fat profit. Every single buy around here would show a fat profit. Every single buy around here would show a fat profit sooner or later when we reach a sentiment high, which is the telltale sign of an actual top, when it's overvalued and there's too much hot money and weak hands in it. Well, I mean, it was probably, I don't know if First Majestic was cheap, but they had already crashed. Anyway, if we just look from here, let's say to there, or to this bottom, that's 476 days. And if you bought all the way down, it would just be varying degrees of profits you would end up having here. Same here, if you just average down and bought this crash, whatever, that's 1,036 days. I think the sector already got cheap back in 2022. I mean, I personally thought this was kind of the bottom or something, especially when it started to go up again. Thankfully, I don't act on that. I just buy stuff as cheap as I can. So I don't deploy more money because it's going up. You know, I typically hold the rips and reshuffle the dips or add more or whatever. But this is, I mean, doesn't this kind of look like what's happening here? You know, a grinding bottom, let's say. And you have this kind of, again, I'm not trading based on this, but you can still see, I think, that First Majestic at least has a history of doing these, you know, whatever you would call it, type of consolidations. And when these breaks, it's like, okay, the next leg up starts. So let's say history repeats. First Majestic is going to blow through this one day and head up here. Okay, how much timing did we need to have? Well, every single buy here would show a profit. Some might show absurd profit. I mean, for First Majestic, that's pretty absurd for a large cap company. 994 days. If could I only make money if I bought the low of the cycle? Would I only make money up here if I bought this exact spot, or only here if this happens, or only here if that happens? Obviously not, right? So how much timing do you need? Like if I could just, okay, every single buy here would show a lot of profits. Every single buy here would show a lot of profits. Every single buy here would show a lot of profits. I assume, don't take that to the bank, but I think every single buy here will show profits. These are years, literally years of time to buy shares and make buys that are probably gonna, I think, prove to be profitable. at the next sentiment high. And that's what people don't think is going to happen this time, that this time is different. And that just tells me again, it's like even people who have been in this sector for I don't know how long, they literally I mean, that's what the market does. It fools you and convinces you that this time is different. Again, that's the very definition of a bottom. When was the time that the least amount of people had any hopes of this sector ever going higher? It's this period of time, this period of time, that period of time, and that period of time, and maybe this period of time. Unless we go to a lower low. So at every single low, it's the least amount of people that think rally is even possible. And of course, if you think it's pretty much impossible, of course you think it's different this time, and this time it's never actually going to go higher. This time the sector is busted. That goes kind of without saying. If you don't think a rally is happening, you think it's different this time. If you've ever seen us short of a cyclical sector, which kind of suggests that, as Pierre Lassonde says, it always crashes and always rallies, always crashes, always rallies, always crashes, always rallies, always crashes. That's the reason he says it's the easiest sector in the world, because it always does that and will always do that. But at every low and every high, people are voting with their feet that this time it's not true. So that's why they get themselves to buy, regardless of how highly valued they are or how cheap they are, they sell. Again, it's like that's the fantasy people tell themselves, I guess, that timing is. I mean, I don't even time at all, so I would know that timing is not required. I sat through this entire move down here and down here and down, not in First Majestic, but still. It wasn't easy making money, let's put it like that, in the junior sector. The thing is that after every single crash, the portfolio went up like 400% before it crashed 50% again. So yeah, that and that. I mean, geology and mining engineering is complex and hard. Human nature never changes, however. So of course it's going to be like, if you're a geologist, you think that you have to know geology to make money in this sector. If you're a mining engineer, you think that, of course, you have to be a mining engineer. Most of them are not good at actually investing in this sector, of course, because I would argue that the most important chart or concept to grasp is cyclicality. Because the moves, or I mean, first Majestic didn't change much, but it moved like they had made a huge discovery, and then it went down like it was a pipe dream that this discovery didn't happen. Then they made another discovery, and then that discovery was proven to be false again. So the moves, just from a sentiment perspective, is akin to basically making discoveries and then not those discoveries turning out not to be true. And again, it's like I see people all the time throw around the phrase opportunity cost. So if you just look, this is a junior that's been around for quite some time. I think this, 2016 top. So after that top, when everybody got in, 4 years of bear market, I sat through this entire move with my portfolio. So it's kind of the same length actually as the recent bear market. So I've seen this before. Obviously, I think that gives me an edge in the sense that I have seen this happen before. I've seen when people are starting to say that this time is different, and the charts suggest that there's absolutely no chance that there's ever going to be a rally in this sector, and it's pricing that in, that there's no chance. And then it happens, and everybody that thought that was bullshit made a shit ton of money. So what do you think people say when we are here? They're going to be looking at what has happened and talk about opportunity cost and give themselves every reason they need to basically give up and sell low, because they're trying to justify selling, right? but this is the funny part. They're using I mean, people could say that if I ask someone like when were when were people smart buying or selling here? You could make a case for a lot of different points. I mean, in a sense, I don't know how much higher this is, but like in a sense, this is actually a pretty good buy, or not good buy perhaps, but not the worst buy, because that would at least show a profit here. Every single buy within this frame would show a profit here. Every single buy would show a loss here. And here people are going to be talking about opportunity cost, yada yada yada. Whereas or anybody who's knows that this is a cyclical sector is going to be thinking, if whatever you average down all the way, so here you're going to look stupid on every single buy, but you might have lowered your average to here, and lo and behold, some 8 months later, the entire portfolio would be up 390% or something. That is absolutely a very good, superb result over this period of time. But it didn't, I don't know what the compound rate is, but let's say it's 30, 40 per year or something. But it's not going to look great because, or during this playing out, it's not going to feel great because you're going to look stupid for this amount of time and then up. So it's like when I'm saying my goal is, around 50% or whatever, that's not, the portfolio is going to go up 50% necessarily per year. Theoretically, it could be down 40% one year, up 200% the next year, then down 30%, and then up, or it's gone nowhere for 1 year, nowhere for 2 years, down 30%, and up 500%. And if you back calculate it, it's like, that's 50% per year. But that's always, again, it's like, this is what we should be focusing on. If you lost money over the last 3-4 years in the junior sector, it's like, you don't need to be the worst investor to do that. It's not easy making money in the bear market, but it's damn hard to lose money in the bull market, and it's typically the bull legs that makes every potential mistake or actual mistake not look like a mistake anymore. But I swear, it's like every day people are going to be bitching, and people are going to be bitching here when it goes down. People are going to be bitching here, especially here when it goes down. And then it goes up and then it turns over. People will bitch. People will bitch here. People will not bitch here. They will bitch here. They will bitch here, bitch here, bitch here. So again, it's like even in a bull, I don't know how many 30% corrections this short has. I mean, from the bottom, and going back, don't kid yourself. You're not going to have 1,748% returns on your portfolio. You might have that the portfolio might go up like that, but it's like 2015 for me, for example. It's like I started buying August, I think. So I started buying here. My portfolio went down 54%, then it went up like 600%. Unfortunately, I didn't have anything in. I didn't participate from $4 to $24 in, but it didn't really matter. I had a bunch of other stuff that performed anyway. But yes, the portfolio went up 600%. But from when I started, it wasn't up 600%. I had a, what was it, 250% return from when I started in the sector. So from here, let's say from here to here, maybe I had 250% returns. Let's see how much this is. Yeah, I mean, about right. Okay, 282. So maybe it kind of mimicked First Majestic. But that's 250. I didn't need to catch the bottom. Would I like to? Of course. But do I need it? No. Then the portfolio went down like 50% down here or down here especially. Then it went up like 400%. So my point is, like, my portfolio goes something like this maybe, or maybe used to. I mean, I'm better at stock picking nowadays, and do a lot of alpha, let's say, investing. But the average compound rate is something like that. So some months or years it's going to be underperforming, then gonna make it all back, and then some maybe, then go down, yada yada yada. So it's not like I'm actually making 50% clean cut every year. And one can pretty much statistically show the sector is dumb as rock. So if it gets us to sell cheap, what does that say about our investing strategy? It's currently pricing in a high risk of mastermind. I mean, that's pretty much true. It's like I used Headwater as an example, and I've used inflection before. It's like it just doesn't add up. And I talked to some people who said, well, you can never really say if a early stage or pre-discovery exploration play is cheap or not, because they haven't actually found something yet. And I mean, I don't agree with that at all. I think there's certainly cases where, I mean, let's put it like this. I like to use extreme examples to prove a point sometimes. So let's say you have one junior that has 5 projects, and I could say 50, but let's stick with 5 projects, and they all have the biggest gold in soil anomalies out there. They haven't proven anything, right? But if that was trading at, let's say they had 9 million in cash, traded for 10 million, enterprise value 1 million. Wouldn't you say that's, and let's say they have a major invested, or 3 majors, 5 majors. Can't you tell that that's cheap, even though they haven't found anything? I mean, cheapness to me is just, risk-adjusted value in a sense. Yes, the spectrum is obviously hard to say, because they might find nothing, they might find a tier 1 deposit, they might find 5 tier 1 deposits, that you don't know, but you should be able to draw some conclusions. Otherwise, why would you ever buy anything? Or, I mean, you could also just stay out of it completely, which I guess you can do it that way. I just don't buy into the idea that you can never tell if they're cheap or not. Because let's face it, I mean, if take Headwater, so if they have first Newcrest and then Newmont as an earning partner, it's like Newmont has a 70 billion market cap. What kind of value? And that's because the fundamentals of the gold business, and apparently, I mean, Newmont is cheap, so maybe they should be the 80 billion, and that's reflecting how valuable any gold ounces are in the ground. I mean, does it make any sense for Headwater to be trading at an enterprise value of 7 million if they have Newmont in there? Yes, if Newmont earns in full, they get to keep 25%, but that's still 25% of a Newmont price, which is at least 2 billion, I would think. Well, at least at today's, I mean, it's not even that hard to get 2 billion, I was going to say. Well, I guess it's kind of hard, but maybe not actually. Anyway, I mean, if you find 1.5 million ounces at decent grade or whatever in Nevada, that's like NPV of that could very much be like almost 2 billion. So then you just back calculate it. Okay, you get to keep 25%, that's 500 million. It has an enterprise value of 7. Of course, it does not account for, potential dilution. Right now they have cash, but you know what I mean. You have to make some kind of judgment. So if you just do an easy back calculation like that, it's like, I mean, it's pricing in, what is that? Well, now it's up a bit, I guess. But anyway, to make the point, it's like, in my opinion, you can kind of statistically show that the market is absolutely batshit crazy. And let's say we give it 2 years or 3 years to actually play out to see if they have that. So let's say 7 million divided by 500 million. So that's 1.4%. Do I think Newmont would go ahead with any kind of earning if they thought the chance of success of finding, and that's the threshold, the Newmont threshold, 1.4% of finding a Newmont size priced? I don't buy that for a second. Why would you spend money if you think it's a 1.4% or 2%? Might be closer to 15 or 20 actually. It's like you don't know. But I'm gonna say, I'm gonna do a judgment call on that. That's way too cheap. But that's what I mean. So, in my opinion, the sector is absolutely dumb as rocks. I think, and this is First Majestic, which is not my favorite, but it's like the sector was dumb as rocks down here, dumb as rocks down here, dumb as rocks, and for lengthy periods. And today it's been some of the longest. I mean, again, it's like the undervaluation for the juniors is the highest ever. So it's never been this stupid, and might not have been this stupid for such a long period of time. So people think that, if it's, I mean, when people say that's the best part. One of the most ironic things is sometimes you say, look at this is dirt cheap, and then somebody says, well, if it was this good, why is it selling this cheap? So he's taking cues from Mr. Market. It's like, well, the market is suggesting it's not that worth that much because it's priced at this. Then the counterpoint to that is obviously, okay, so you're letting the market tell you how good something is. It's like you can never tell if it's cheap because you're always going to be trusting Mr. Market. How are you going to make money now again? Remind me. Because you can never find something cheap because you think, well, if it was cheap, it wouldn't be cheap. I mean, that makes no sense at all, really. I mean, either you're out to beat the market or not. I assume that the market has no clue what it's doing. If I'm wrong, I can only lose 100%. If I'm right, I could make 1,000%. So that argument is so dumb in a sense because, like, that's the prerequisite of finding an opportunity is that the market is having it too cheap. The market is not pricing in how much it's actually worth. So you bet on that. If you're right, you're gonna outperform the market. I mean, that's how it works. Because otherwise it's like, well, I'm gonna buy this because the market is saying that it's worth this much, and if the trend is going like that, it suggests that the fundamentals are going like that. So it's just no. It was overvalued here. Yes, fundamentals have gone up, but it's actually overvalued. So that's also, it's like if you think like that, of course you're gonna buy high and sell low. Because every time something is like remarkably dirt cheap, moronically cheap, that even somebody with an IQ 70 should figure out is a buy, you're going to be thinking, well, it can't be cheap because the market has priced this and the market is always right. Well, you're never going to make any money. So like Brandon Baylor, imagine moving gold miners if investors starts allocating to the space like they did in 2009, 2012. And that's was an earlier point. It's like when this sector rotation appears to have started, when that happens, it takes on a life of its own. It starts momentum, and momentum gets other people involved, yada yada yada. And typically, when the momentum has been going on for some time, it gets again more and more people into it, and they'll bid it higher and higher and higher because those people don't care about the valuations. They care about the momentum, which what the short-term trend is. And typically, one would think that, or historically, a sentiment high, a bubble peak, or a top, whatever, usually comes with overvaluation. So, play with the idea, and this is not even an unreasonable idea. It's like, historically speaking, tops tend to be when the sector is overvalued, pricing in a higher gold price, pricing in higher margins than the sector has currently. So imagine gold goes to 3,500 or 4,000 by the time the sector actually gets enough momentum. And again, that might have started, but it's like, it gets more and more momentum. Because, I mean, on the monthly, it kind of looks like maybe gold is actually about to accelerate in a sense, which feels kind of weird, given that, I mean, everybody's kind of expecting a top. I've been expecting a top since like 2,300. But picture this scenario. Gold is at $4,000. The sector has got an interest. There's sector rotation that's been ongoing. The momentum is up. The trend is up. More and more people have gotten into it. And at $4,000 per ounce, the sector is so hot that actually pretty much every company is overvalued. So let's say we go to $4,000. Let's say the costs are still around $1,500, maybe more, maybe less, but let's say $1,500. So all of a sudden the margin is $2,500 per ounce. Let's say the market is starting to price in $3,000 per ounce. What do you think a gold ounce in the ground is going to be trading at if the juniors are also in a hot sentiment environment? If gold in the ground, especially the gold in the ground that can actually become a mine at much lower gold prices, trades for, or what would overvaluation be if the margins on those ounces is like $2,500? Should they be trading at $1,500 per ounce? $1,000 per ounce? I don't know, but a shit ton, or a shit ton more than where it's here. Even the Newmonts, etc., would be, I don't know, 200% higher. That is not an unreasonable future. That's just going by historic tendencies of the market. A top, an obvious top or a major top is when sentiment is hot, euphoric, or at least very high, and yada yada yada. I didn't realize First Majestic actually reached the 2011 highs. Anyway, so a top tends to coincide with overvaluation by definition, since it's momentum that drives it and goes way past the fundamentals, because the silver price wasn't going up this quickly. Are we anywhere near that? No, but we might be, or we should be one day, because that's always what tends to happen in any sector. And then just look at, okay, where are we now? Well, even First Majestic from a chart perspective looks like it's grinding out a bottom. That's the price. So it's like I've seen some people congratulate me and thank me for some pick that's up 30-50%. It's like, yes, thank you for acknowledging. Usually it's like 10-to-1 ratio. You get shit when something is down, but never hear anything if something is up. But to that point, don't thank me if take a high risk high reward case. The case is not that we're going to be cheering if it's up 50%. The case worked if they actually make a significant discovery and they go up 10 to 30x in just in time for at the next sector peak, let's say. Then we're talking like fundamentally, yes, this is one of those few juniors that actually made a significant success. It proved to be not only a discovery, but a significant discovery, and the discovery was real because they found a world-class ore body or something. That is a successful case. If dirt cheap junior is up 50% from these levels, especially a pre-discovery junior, that's not success. The case was not about that. The case was not that one day I might be up 50% and then look how smart I was. No. So that's not a case having played out yet. This is actually, I think this is pretty accurate. Like if you just where is it? Where's the cyclical sector? If you were just a monkey that understood the game of Pong, you would just buy low and sell high. You can even take ETFs like GDXJ or whatever, I guess. But like at producers trading sardines or what have you, just buy when they've crashed like 70, 80, 90% and then wait to make money. That's one way to go about it. You don't even actually need to know. You have to be prepared to wait for X amount of years, but you're gonna end up making money. Assuming you don't bet on one company that could obviously fail, because First Majestic could get hit by a whatever, something happens, But if you have 10, 20, whatever, probably not every producer is gonna go bankrupt. Yeah, then I would think if you just knew how to play Pong and had a lot of patience that could average down, you were only good at those things: playing Pong, being able to average down, and pick decent, even trading sardines. You're probably gonna make money forever in this sector. At least if you have some kind of idea when they're actually overvalued, like when they're pricing in a higher silver price than the current price. My approach is, I don't care about necessarily buying low and selling high, because that's more of a trading thing. I buy cheap, and I sell if I find something cheaper or something becomes expensive. That's my approach. That's what I've stuck with kind of since day one, and that has proven to be profitable. And then you have 95% of people who think the market knows something, the trend is down, Mr. Market is always right. Use any and all excuses why they will never think that it's a good idea to buy something that's not gone up in the last 2, even 3 years. And again, well, I should have. Yeah. So the caveat being, it's like I don't want. I said this before. I don't want people to think that well, I can buy anything because like, yes, this is a cyclical sector. There's going to be a big difference. It's like I'm not even in a real optionality place. Yes, I own ounces in the ground, but these are typically high quality ounces that can also grow where I get exploration potential for free. So my assumption at all times is kind of that the sector sentiment is not going to get better, so I'm not waiting for the sector sentiment to bail me out. I'm not waiting for this sentiment spike to bail me out. That's more again like a trader's perspective. My goal is that to find companies that could create quite a bit of value, over the next 1, 2, 3 years. If I'm right on that, I'm gonna make money probably, even if the sentiment is unchanged, even if an ounce in the ground is valued at the same price as today, and even if the sector gets even worse or the gold price falls or something, I could literally make money in that bear market or neutral to bear market kind of scenario. The caveat being, if we also go into a hot sector environment and this, ace up the sleeve, the sentiment premium or multiplier comes into effect over that period of time, I'm simply going to make more. So step one, just try not to get killed before the next peak, meaning that you don't want to be in companies that have basically obliterated the share structure, diluted to hell, and or have failed cases. Because like if you're down here and every case failed or whatever, yeah, it's going to take some time to make that back, right? I mean, the best option to that is obviously to just deposit more money and buy some good stocks, for example. But it's like we want staying power when we're at lows, because we don't know if it's going to turn on a dime or if it's going to be more dragged out. Step 2, advance. Try to find some companies that might actually have created value until next peak. Step 3, keep doing step 2 only and forever. So this is basically what I'm doing. I'm excited about every company I own. I am excited about the fundamentals, the value creation potential, what they could prove up, what they could find, what they could advance, and the value that is today, or even at higher gold prices, even at lower gold prices, and then I look at the price I'm paying for those assets. So I don't really care if we're in a bull market or a bear market, in the sense that, I mean, if you're on or if your cases on average play out, I mean, some will fail, some will not. You're probably gonna make some kind of money even in a bear market. You're just gonna make a lot more when we go from through the easy times, and then it's gonna get harder again when we're up here, because the next big move from euphoric highs is down. Next big high from euphoric highs is down. Next big inevitable move from euphoric highs is down. Next obviously big move from depression lows is up. Depression lows is up. Depression lows is up. Depression lows is up. We want to make sure we catch that wave, but I don't mind. I actually focus on legit companies, high quality stories that I think also that if we peak in 3 years time from now, I hope that the average company I own will have be worth 300% more from intrinsic value perspective. Then I might get 300% extra just from the sentiment perspective. But if they create enough value, it's going to be hard even in a shitty sentiment to keep those stocks down. Pretty simple. It's like an all-weather approach. And right now, yes, birds in the hand are selling for obnoxiously cheap levels. I think even I could make almost pure optionality portfolio and make money. I could make pure actually pre-discover early stage portfolio that could make money. Maybe I only need 3-4 out of 20 to actually work out, because they might, from bottom to top or pre-discovery to peak, go up 30x. It's like, you never know. But my focus is stock picking. That's the number one thing, stock picking. And I try to remember what Pierre Lassonde said about the market is bad at pricing and optionality. So you can tell why some of my favorite stories are what they are, because I think they have a shit ton of free optionality. So it's almost a rigged bet to the upside in a sense. I mean, they're selling for way too cheap than based on what they already have, and they might have even more. So that's risk-free upside. Anyway, thanks for listening. Don't consider this investment advice. Don't buy, or if I talked about any companies, consider me biased. I might own shares of them. They might be banner sponsors. Don't invest any money you cannot afford to lose. Consider me biased. This sector is risky, all of that. Thanks for listening. Bye bye.